There is a single, immutable law of the marketplace, a truth so fundamental that it governs the rise and fall of empires, both corporate and personal. It's a principle that Warren Buffett, the Oracle of Omaha, has condensed into a beautifully simple and terrifyingly potent sentence. It takes 20 years to build a reputation and 5 minutes to ruin it. Think about that. 20 years of daily effort, of promises kept, of products delivered, of trust painstakingly earned, one customer at a time. 2 decades of early mornings and late nights, of ethical choices made when no one was watching, of building a fortress of goodwill brick by painful brick. All of it can be reduced to ash in the time it takes to read a single, devastating headline, a single safety recall, a single act of executive malfeasance, a single lie exposed. 5 minutes. That is the asymmetric reality of the single most valuable asset a company possesses, an asset that never appears on a balance sheet but which determines the fate of everything that does, its reputation. Most investors, even professional ones, treat this concept as a soft, fuzzy, unquantifiable variable. They get lost in the spreadsheets, the earnings projections, the debt-to-equity ratios. They analyze everything that can be easily measured, and in doing so, they miss the one thing that matters most. They fail to understand that a sterling reputation is not just a nice-to-have public relations concept. It is a cold, hard, economic moat. It is a competitive advantage more durable than any patent, more powerful than any factory, and more valuable than any brand name alone. A great reputation allows a company to charge more for its products, to attract the best talent, to receive the benefit of the doubt from customers during a crisis, to borrow money more cheaply, and to command a premium valuation from the stock market. It is a force multiplier for every single financial metric you can track. Conversely, a tarnished reputation is a cancer. It repels customers, demoralizes employees, attracts regulators, and invites short sellers. It is a discount factor that infects every aspect of the business, turning assets into liabilities and future profits into future litigation costs. The market is a graveyard of companies that learned this lesson the hard way. Businesses that chased a quick buck by cutting a corner on ethics, on safety, on product quality, only to discover that the corner they cut was the very foundation of their entire enterprise. They saved a few $1,000,000 in the short term, and in exchange, they vaporized billions of dollars in long-term shareholder value. This is not a mistake you can afford to make. It is the very definition of a permanent loss of capital. This journey we are about to embark on is a deep dive into this foundational principle. We will dissect it, analyze it, and transform it from a philosophical proverb into a rigorous, actionable investment framework. You will learn to see reputation not as an afterthought, but as the central pillar of any sound analysis of a business. You will develop the CEO mindset required for effective portfolio management, a mindset that prioritizes long-term capital preservation above all else. This is not about abstract ethical investing. This is about a pragmatic understanding that good ethics is good business. By the end of our time together, you will have the tools to identify companies that are building their reputational fortress brick by brick, and you will learn to spot the cracks in the walls of those who are about to suffer the 5-minute catastrophe. You will understand that the secret to beating the market and achieving true financial freedom isn't about finding the next hot stock. It's about finding the businesses with a reputation so pristine, so powerful, that they are virtually destined to print money for decades to come. Our exploration will be structured around 5 fundamental pillars, each one unlocking a deeper layer of this critical concept. First, we will examine the moat of trust, understanding how reputation serves as the ultimate, unbreachable competitive advantage. Second, we will confront the asymmetric risk of ruin, dissecting the terrifying speed with which that advantage can be destroyed. Third, we will learn how to identify the culture of integrity, looking beyond the numbers to find the unwritten rules that govern a company's behavior. Fourth, we will quantify the unquantifiable by understanding the price of a bad name, connecting reputational damage directly to the financial statements. And finally, we will embrace the long game, learning how compounding goodwill is the true secret to building generational wealth. This is the blueprint for quality investing, for moving beyond the noise of the market and focusing on the enduring principles of value that separate the fleeting successes from the lasting dynasties. This is the final promise of sound investing. That character over the long run is destiny. Let us begin with the first pillar, the moat of trust. To truly grasp the offensive power of a great reputation, we must travel back in time to 1972. Warren Buffett and his partner, Charlie Munger, were on the hunt. They weren't looking for a technology company or a flashy growth stock. They were looking at a humble, family-owned business based in California, See's Candies. On the surface, it was an unremarkable investment. It was a mature business, selling chocolates and sweets, with modest physical assets. The numbers were good, but not spectacular. The real asset, the one that caught the eye of these two master capital allocators, was invisible. It was the fierce, unshakable loyalty of its customers. For 50 years, See's had built a reputation for uncompromising quality. In the mind of the California consumer, the See's Candies box wasn't just a container for chocolate. It was a symbol of celebration, of quality, of trust. It was the go-to gift for Valentine's Day, for Mother's Day, for Christmas. It was a social convention. Buffett and Munger paid $25 million for the company, a price that seemed high to many at the time, as it was significantly above its book value. What they were buying, however, was not the candy-making equipment or the inventory. They were buying the decades of positive associations stored in the collective consciousness of their customer base. They were buying the brand value. And what happened next became a pivotal lesson in Buffett's education, transforming him from a classic value investor who bought cheap, statistically bargain companies into a quality investor who sought out wonderful businesses at a fair price. Every year, after they bought the company, the cost of cocoa, sugar, and labor would go up. And every year, on December 26th, Buffett and the CEO of See's, Chuck Huggins, would have a conversation about raising prices for the following year. And every year, they did. They could raise the price of a box of chocolates by 10, 15, even 20%, and the customers would grumble for a moment, and then they would pay it. They kept coming back. Why? Because the cost of switching was not monetary, it was emotional. To show up to a family gathering with a lesser box of chocolates was a social risk. See's reputation for quality had created what Buffett would later call pricing power. It was an economic moat filled not with water, but with trust. That initial $25 million investment would go on to generate over $2 billion in pre-tax earnings for Berkshire Hathaway, all while requiring very little additional capital investment. It was a money machine, and the engine of that machine was its reputation. This phenomenon is powered by a potent cognitive bias known as the halo effect. The halo effect is a mental shortcut our brains use, where our overall impression of a person, a brand, or a company influences our feelings and thoughts about their specific traits. Because customers had an overwhelmingly positive overall impression of See's Candies, it's a high-quality, trustworthy brand, they automatically assumed that any new product would be excellent, that the service would be friendly, and that the price, whatever it was justified. The positive reputation acted as a halo, illuminating every other aspect of the business in a favorable light. This is an incredibly powerful force in business. It makes customers less sensitive to price increases, as we saw with See's. It makes them more forgiving of minor mistakes. If a trusted company has a small issue, customers are more likely to assume it's a one-time fluke, whereas a single mistake from a company with a shaky reputation is seen as proof of its inherent incompetence. Furthermore, the halo effect combines with another bias, social proof. When we see generations of our friends and family buying See's Candies, it signals to us that this is a safe, reliable choice. The brand's long-standing reputation becomes a social convention, a default option that requires no extra mental effort to choose. We trust it because everyone else trusts it. This combination creates a virtuous cycle. A strong reputation attracts loyal customers, whose loyalty enhances the reputation, which in turn attracts even more customers. It's a self-reinforcing loop of trust and profitability. So how can we, as diligent investors engaged in sophisticated stock analysis, translate this powerful psychological principle into a practical, applied mental model? We can develop what I call the reputation audit checklist, a blueprint for identifying companies that possess this deep moat of trust. The first step is the pricing power test. This is the core lesson from See's Candies. Ask yourself, could this company raise the price of its core product or service by 10% tomorrow without losing a significant number of its customers to a competitor? Think of companies like Apple with its iPhone, or Coca-Cola with its sodas, or American Express with its charge cards. Their reputations for quality, status, and reliability give them immense pricing power. You can investigate this by looking at their historical financial statements. Track their gross margins over a decade. A company with pricing power will typically have high and stable, or even rising, gross margins. A company in a brutal, commoditized business will see its margins fluctuate wildly as it's forced to compete solely on price. The second step is to analyze customer loyalty metrics. This goes beyond simple revenue figures. Look for the company's Net Promoter Score, or NPS. This metric measures how likely a customer is to recommend the company to a friend. A high NPS is a direct indicator of a powerful reputation. Dig into customer retention or churn rates. A company that keeps its customers year after year is clearly doing something right. Read online reviews, not just for the star rating, but for the sentiment. Are customers expressing delight and gratitude, or are they constantly complaining about poor service and broken promises? The third step is the employee turnover test. A company's reputation isn't just external, it's internal. Great companies with great reputations tend to be great places to work. They attract and retain top talent. You can research this by looking at employee reviews on sites like Glassdoor. Look at a company's average employee tenure and compare it to its industry peers. High employee turnover can be a massive red flag, a leading indicator that the internal culture is toxic, which will inevitably spill over into how the company treats its customers. Finally, apply the painkiller versus vitamin test. Is the company's product or service a vitamin, nice to have, but easily discarded? Or is it a painkiller, something so deeply integrated into the customer's life or workflow that the pain of switching to a competitor would be immense? Think of a company like Intuit, the maker of QuickBooks. For a small business owner, the thought of migrating years of financial data to a new accounting system is a nightmare. That high switching cost, built on a reputation for reliability, gives Intuit a deep and durable moat. By running a potential investment through this four-part checklist, you begin to see the tangible signs of a powerful reputational advantage, the kind of advantage that leads to long-term, sustainable profits. To fully appreciate the wisdom of this approach, we must examine its antithesis, the path of the 99% of investors and managers who sacrifice reputation for the illusion of growth. The most stark example of this is the tragic story of Valeant Pharmaceuticals. In the early 2010s, Valeant was a Wall Street superstar. Its stock price soared as it pursued a seemingly brilliant business strategy: acquire other pharmaceutical companies, slash their research and development budgets to zero, and then aggressively hike the prices of their life-saving drugs. One infamous example was the heart medications Nitropress and Isoprel, whose prices were increased by 212% and 525% respectively, immediately after Valeant acquired the company that made them. For a time, this strategy worked wonders on the income statement. Revenue and profits exploded. Hedge funds and mutual funds piled into the stock. Mesmerized by the short-term numbers, they ignored the fact that Valeant was building nothing. It was creating no new drugs, fostering no innovation. Instead, it was systematically destroying the goodwill of patients, doctors, and insurers. Its reputation was being burned to fuel quarterly earnings reports. The company's executives were celebrated for their, quote, efficiency and shareholder focus, when in reality they were engaged in a form of corporate arson. The path of the 99% is to see a stock price going up and to jump on board without ever asking the fundamental question, is this company creating or destroying value in the world? Valiant was a value destruction machine masquerading as a growth stock. When the public and political scrutiny inevitably came, the entire house of cards collapsed. The business model was exposed as predatory and unsustainable. The stock price, which had peaked at over $260 per share, plummeted by more than 95%, wiping out tens of billions of dollars in shareholder wealth. It was a 5-minute ruin that was 20 years in the making, the direct result of a corporate philosophy that treated reputation not as an asset, but as an expendable resource. This is the ultimate danger of ignoring the moat of trust. This brings us to the direct financial connection, the process of translating the abstract concept of reputation into the cold, hard numbers on a financial statement. A strong reputation, the kind built by See's Candies, has a powerful and direct impact on a company's financial performance. First, it leads to higher and more stable gross margins. Because the company has pricing power, it can pass on rising costs to its customers without sacrificing profitability. This is a massive advantage, especially during inflationary periods. Second, it results in lower customer acquisition costs. A company with a great reputation doesn't have to spend as much on advertising and marketing, because its best marketing is word of mouth from its delighted customers. This efficiency flows directly to the bottom line as higher operating margins. Third, it creates a more predictable and durable revenue stream. Loyal customers are repeat customers. This reduces the volatility of a company's sales, making its future earnings easier to forecast and, therefore, more valuable to investors. All of these factors, higher margins, lower costs, and stable revenues, combine to produce a higher return on invested capital, or ROIC, which is one of the ultimate measures of a superior business. The stock market, over the long run, is a weighing machine. It recognizes this superior quality and rewards it with a premium valuation, often in the form of a higher price-to-earnings, or PE, ratio. Investors are willing to pay more for a dollar of earnings from a high-reputation company because they believe the dollar of earnings is safer and more likely to grow in the future. So when you are performing your stock analysis and you see a company trading at a premium to its peers, don't automatically dismiss it as expensive. First, run it through the reputation audit checklist. You may discover that the premium is not a sign of market irrationality, but rather a fair price for an extraordinary and extraordinarily profitable moat of trust. This is the essence of quality investing and the first step toward building a portfolio designed for true capital preservation and long-term wealth management. Now we must turn to the other side of the coin, the dark and terrifying twin of the moat of trust. We must confront the second pillar, the asymmetric risk of ruin. If reputation is a fortress, it is a fortress made of glass. Strong, clear, and valuable, but tragically fragile. The story that best illustrates this terrifying reality unfolded in 1991, and it nearly brought down one of the most powerful firms on Wall Street, placing Warren Buffett himself in the eye of the storm. The company was Salomon Brothers, a legendary bond-trading powerhouse. Berkshire Hathaway was its largest shareholder, with a $700 million investment, and Buffett sat on its board of directors. In August of that year, a scandal of epic proportions erupted. It was discovered that a rogue trader, Paul Moser, had been submitting false bids in U.S. Treasury auctions to corner the market, a blatant and illegal violation of federal law. Worse still, the top executives of the firm, including its CEO John Gutfreund, had known about the misconduct for months and had failed to report it to the authorities. The news hit the market like a lightning strike. In an instant, Salomon Brothers' reputation, built over decades of being a pillar of the financial system, was shattered. Their very survival was at stake. The U.S. Treasury threatened to ban them from bidding in its auctions, which would have been a death sentence for a firm whose lifeblood was trading government bonds. The company was facing a full-blown liquidity crisis, as its clients and trading partners, fearing Salomon was no longer a trustworthy counterparty, began pulling their business en masse. The stock price was in freefall. This was the 5-minute ruin, happening in real time. It was at this moment that Buffett staged one of the most dramatic interventions in modern corporate history. He effectively seized control of the firm, forcing the CEO to resign and installing himself as the interim chairman. He flew to Washington, D.C. to personally plead with the Treasury Secretary to spare the firm, not for the sake of its executives, but for the sake of the financial system and the thousands of innocent employees. It was during his testimony before Congress that he delivered the line that has become the defining statement on the paramount importance of reputation. He looked the committee in the eye and said, "Lose money for the firm, and I will be understanding. Lose a shred of reputation for the firm, and I will be ruthless." He understood the asymmetry perfectly. You can always make more money. You can never, ever fully recover a reputation once it is lost. Thanks to his personal credibility and swift, decisive action, Salomon Brothers was saved from immediate collapse. But the scar remained. The firm was permanently damaged and was eventually forced to sell itself years later, a shadow of its former self. For Buffett, it was the ultimate lesson in risk management. The greatest risk is not a market crash or a bad economy. It is the sudden, catastrophic, and often self-inflicted loss of institutional integrity. The violent market reaction to a scandal like the one at Salomon Brothers is not just a matter of financial calculation. It is driven by deep-seated psychological principles, primarily prospect theory, and its most famous component, loss aversion. Developed by psychologists Daniel Kahneman and Amos Tversky, prospect theory describes how people make decisions under uncertainty. One of its key findings is that we experience losses far more acutely than we experience equivalent gains. The pain of losing $100 is roughly twice as intense as the pleasure of gaining $100. A reputational catastrophe triggers an overwhelming sense of loss aversion in all of the company's stakeholders. For investors, the scandal represents not just a past loss, the initial stock drop, but more terrifyingly, the prospect of future unknown losses. How deep does the rot go? What other scandals are waiting to be uncovered? This uncertainty creates a panicked rush for the exits, as the fear of losing even more money overwhelms any rational analysis of the company's underlying asset value. For customers, the scandal shatters their trust, creating a sense of betrayal. They feel the loss of a reliable partner or a safe product, and they flee to competitors not just for practical reasons, but for emotional ones. They are averse to the risk of being burned again. For employees, the loss is one of pride and identity. Their association with the company suddenly becomes a source of shame rather than pride, leading to a collapse in morale and a flight of talent. The key insight here is that the total damage from a reputational crisis is always greater than the sum of its parts. The financial cost of the fines and lawsuits is only the beginning. The real damage is the cascade of loss aversion that spreads like a virus through every relationship the company has, amplifying the initial shock into a full-blown crisis of survival. Understanding this asymmetric risk is not enough. We must have an applied mental model to proactively identify and avoid it. This is where we introduce the pre-mortem analysis, a powerful technique for stress testing a potential investment for hidden reputational risks. A standard post-mortem is conducted after a failure to figure out what went wrong. A pre-mortem, in contrast, is a prospective exercise in paranoid imagination. You begin by assuming that the company you are analyzing has failed spectacularly. Imagine it is 1 year in the future, and the company's stock has gone to zero. Now work backward and write the story of how it happened. The first step is to identify the core reputational asset. What is the one thing this company absolutely cannot afford to lose? For a bank like Wells Fargo, it's the customer's trust in their financial stewardship. For a food company like Chipotle, it's the public's confidence in the safety of their ingredients. For a social media company like Facebook, it's the user's belief that their personal data is secure. Pinpoint that single, critical pillar of their reputation. The second step is to brainstorm catastrophic failures. Based on that core asset, what are the most plausible disaster scenarios? What headlines would you read in the Wall Street Journal? For Wells Fargo, it was the discovery of millions of fake accounts created by employees under intense pressure to meet sales quotas. For Chipotle, it was a widespread E. coli outbreak. For Facebook, it was the Cambridge Analytica scandal. Be specific and realistic. The third step is to trace the pathways to failure. How could these disasters actually happen? What internal pressures or cultural flaws could lead to these outcomes? This requires you to dig deeper than the financial statements. Look for leading indicators of risk. Are there reports of regulatory investigations in the company's SEC filings? Is there a pattern of lawsuits related to product safety or employee mistreatment? Are there whistleblower reports? Is executive compensation tied to aggressive, short-term sales goals that might incentivize unethical behavior? This is investigative journalism applied to portfolio management. The final step is to assess the apology power of the management team. Look at how the company has handled smaller controversies in the past. Did they take responsibility, act transparently, and fix the problem? Or did they deny, deflect, and try to cover it up? A management team with a history of honesty and accountability is far more likely to successfully navigate a major crisis than one that is arrogant and defensive. By conducting this pre-mortem analysis, you force yourself to think like a risk manager, not just a stock picker. You systematically search for the hidden icebergs that could sink an otherwise beautiful-looking ship. The antithesis of this careful, paranoid approach is the common but perilous path of the 99%, chasing turnaround stories in scandal-plagued companies. This is the gambler's fallacy applied to investing. An investor sees a company's stock fall 50% after a major scandal and thinks the bad news is already priced in. It can't get any worse. This is one of the most reliable ways to destroy capital. Let's take the example of Wells Fargo. When the initial news of their fake account scandal broke in 2016, the stock took a significant hit. Many value investors, seeing a venerable institution trading at a discount, rushed in to buy. They believed the problem was contained and that the brand was strong enough to recover. They were wrong. What they failed to appreciate was that a reputational scandal is rarely a single event. It is often the symptom of a deeply diseased corporate culture. In the years that followed, a steady drumbeat of new revelations emerged. The bank had improperly repossessed the cars of military service members. It had charged mortgage customers for unnecessary fees. It had sold unwitting clients inappropriate insurance products. Each new headline was another body blow to the company's reputation and its stock price. The investors who bought the initial dip were not buying a bargain, they were catching a falling knife. The lesson is that the market consistently underestimates the long-tail costs of reputational damage. The first price drop rarely captures the full extent of the rot. The path of the 99% is to be seduced by a cheap price tag, while the path of the professional is to understand that a business with a broken culture and a shattered reputation is never truly cheap, no matter how low the stock price goes. True capital preservation requires avoiding these situations entirely, not trying to be a hero and guess the bottom. The financial consequences of such a ruinous event are both immediate and devastatingly long-lasting. Let's connect this directly to the financial statements and valuation. The most immediate impact of a reputational crisis is a permanent derating of the stock. This is a term used in stock analysis to describe when the market decides to assign a permanently lower valuation multiple, such as a lower PE ratio, to a company's earnings. Even if Wells Fargo's earnings were to fully recover to their pre-scandal levels, the market would no longer be willing to pay, say, 12 times those earnings for the stock. Because of the perceived risk and the broken trust, it might only be willing to pay 9 times earnings. That's a permanent 25% loss in shareholder value, right off the top, even in a best-case recovery scenario. But the damage runs much deeper and directly impacts the income statement and balance sheet. On the income statement, you see a surge in operating expenses. The company has to pay massive regulatory fines, which in Wells Fargo's case ran into the billions. It faces years of costly litigation from customers and shareholders. It must pour hundreds of millions of dollars into public relations campaigns and marketing to try and repair its brand. It has to hire legions of compliance officers and auditors to satisfy regulators. All of these are real costs that directly reduce earnings per share. On the balance sheet, the company's cost of capital goes up. Lenders will demand higher interest rates to compensate for the increased risk of doing business with a disgraced firm. Its credit rating may be downgraded. These higher borrowing costs further depress profitability. In essence, a major reputational scandal acts as a massive, multifaceted tax on the company's future profits. It is the very definition of shareholder value destruction. This is why Buffett's admonition to be ruthless about reputation is not a moral exhortation. It is a cold, calculated principle of financial risk management. Having established the immense value of a great reputation and the catastrophic risk of its loss, we now arrive at the critical, practical question. How do we actually identify these high-character companies before they become obvious successes? This brings us to our third pillar, the culture of integrity. This is about learning to read the unwritten rules of an organization, to see the invisible architecture of ethics and values that supports the entire business. To understand this, we must go back to another one of Buffett's formative investments, one that was based not on a spreadsheet but on a handshake and a gut feeling about a person's character. The person was Rose Blumkin, better known as Mrs. B, and the company was the Nebraska Furniture Mart. Mrs. B was a Russian immigrant who arrived in America unable to read or write English. In 1937, with a $500 loan, she started a small furniture store in Omaha, Nebraska. Her business philosophy was brutally simple and profoundly effective: sell cheap and tell the truth. She worked tirelessly, buying directly from manufacturers to cut out the middleman, and she passed those savings on to her customers. She was famous for her honesty. If a product had a flaw, she would point it out and offer a discount. Her word was her bond. Over the decades, she built the Nebraska Furniture Mart into a retail behemoth, the single largest home furnishings store in North America, all from a single location in Omaha. She created a local monopoly not through predatory tactics, but through earning the absolute, unshakable trust of her community. In 1983, a 90-year-old Mrs. B agreed to sell a majority stake in her company to Warren Buffett. The deal was sealed not with a team of lawyers and months of due diligence, but with a simple 2-page contract and a handshake. Buffett didn't even have the business audited. Why? Because he knew he was buying something far more valuable than inventory and real estate. He was buying the culture of integrity that Mrs. B had personally embodied for nearly 50 years. He knew that this culture, this relentless focus on customer value and honest dealing, was the company's true secret sauce. It was an asset that couldn't be easily replicated by any competitor. The story of Mrs. Kyle B and the Nebraska Furniture Mart is the perfect illustration that a culture of integrity is not a vague corporate slogan. It is a tangible economic force that starts at the top and permeates every fiber of a successful long-term enterprise. The reason a strong culture of integrity is so powerful is that it creates what Charlie Munger calls a Lollapalooza effect, a confluence of multiple psychological biases all working together in the same direction to produce an extraordinarily powerful outcome. It is not just one thing, it's a virtuous combination of many. First, you have the commitment and consistency bias. When a company consistently acts with integrity, its employees and customers develop a deep-seated commitment to it. Employees are more likely to stay with the company and go the extra mile because they believe in its mission and feel proud to work there. Customers remain loyal because the company's behavior is consistent with their expectations of quality and fairness. This consistency builds a powerful bond that is difficult for competitors to break. Second, you have the principle of reciprocity. When a company treats its employees with respect and its customers with honesty, it triggers a powerful human instinct to reciprocate. Employees work harder and are more loyal. Customers are more likely to recommend the business to their friends and are more understanding if a minor problem occurs. This creates a positive feedback loop of goodwill. Third, there is the principle of authority. A leader with unquestionable integrity, like Mrs. B or Warren Buffett himself, sets a powerful example that cascades throughout the entire organization. Their actions, more than any mission statement on a wall, define what is acceptable and what is not. When the CEO demonstrates a commitment to doing the right thing, even when it's not the most profitable thing in the short term, it gives everyone in the organization permission and encouragement to do the same. This combination of commitment, reciprocity, and authoritative example creates a self-policing culture where integrity is not just a rule to be followed, but a shared identity to be upheld. So how can we, as outside investors, peek behind the curtain and accurately assess a company's internal culture? We need an updated version of the classic investment technique known as scuttlebutt. Popularized by the legendary investor Philip Fisher, scuttlebutt is the process of gathering information about a company from a wide range of sources, not just from the company itself. We can call our model the Scuttlebutt Method 2.0, adapted for the digital age. The first step is to read the letter. The annual shareholder letter, personally written by the CEO, is one of the most valuable documents for assessing culture. Read at least 10 years' worth of them. Does the CEO write with clarity and honesty, or is the letter filled with impenetrable corporate jargon and buzzwords? A CEO who can't explain their business in simple terms may be trying to hide something. Crucially, do they admit their mistakes? A management team that openly discusses its failures is demonstrating humility and a commitment to learning, which are hallmarks of a healthy culture. A team that only trumpets its successes is likely arrogant and prone to hiding bad news. The second step is to analyze executive compensation. The company's proxy statement is a treasure trove of information about its true priorities. Is the executive bonus plan tied to sustainable, long-term value creation metrics like return on invested capital or customer satisfaction? Or is it tied to volatile, short-term metrics like quarterly earnings per share or the daily stock price? Compensation schemes that reward short-term thinking are a direct incentive for managers to cut corners and engage in risky behavior. You want to find companies where management eats its own cooking, with a significant portion of their net worth in the company's stock, aligning their interests directly with long-term shareholders. The third step is to talk to the ecosystem. Thanks to the internet, we can now gather scuttlebutt on a massive scale. Read employee reviews on Glassdoor. Are employees happy, motivated, and proud of their workplace, or are they complaining about a toxic culture and unethical pressure from management? Look up the company on the Better Business Bureau website. Is there a long history of unresolved customer complaints? See how the company is discussed in industry forums and trade publications. Are they respected by their suppliers and competitors? This 360-degree view gives you a much richer picture of the company's character than any financial report ever could. Finally, apply the front page of the newspaper test. This is a mental model that Buffett himself often shares with his managers. He tells them to imagine that any action they are contemplating is going to be written up on the front page of their local newspaper the next day, to be read by their friends, family, and neighbors. Would they still be proud of that action? This simple heuristic cuts through complex ethical dilemmas and gets to the heart of the matter. As an investor, ask yourself, does this management team seem to be operating by that standard? Reading their public statements, their strategic decisions, and their handling of controversies, do they seem like people who are constantly mindful of their public character? By systematically applying this four-part method, you can move beyond the numbers and develop a real, intuitive feel for the integrity of a company's culture. To truly understand the vital importance of this cultural due diligence, we must once again examine the antithesis, the path of the 99% who are seduced by beautiful numbers that hide an ugly reality. There is no more powerful cautionary tale in this regard than the spectacular collapse of Enron in 2001. On the surface, and according to its audited financial statements, Enron was a miracle of the new economy. It reported year after year of stunningly smooth and predictable earnings growth. It was lauded by Wall Street analysts and business publications as one of the most innovative companies in the world. Its stock was a must-own for any growth-oriented investment portfolio. Investors who relied solely on quantitative analysis saw a perfect picture. The numbers were flawless. But beneath the surface, Enron's culture was a cesspool of arrogance, greed, and deceit. The company's infamous rank and yank performance review system, where the bottom 10% of employees were fired each year, created a brutal, backstabbing environment. Its executives, led by Ken Lay and Jeffrey Skilling, fostered a cult of personality and openly expressed contempt for the rules. They used complex and fraudulent off-balance sheet accounting entities to hide massive debts and inflate earnings. The entire enterprise was a lie, a financial fiction designed to enrich a small group of insiders. The quants and the spreadsheet jockeys missed it completely. They were so focused on the reported numbers that they failed to see the flashing red lights of a terminally broken culture. They didn't read the signs of executive hubris, the insane complexity of the financial reports which was designed to confuse, or the reports from whistleblowers that were systematically ignored. When the fraud was finally exposed, the company collapsed into bankruptcy almost overnight, wiping out $60 billion of shareholder value and the life savings of thousands of its own employees. Enron is the ultimate lesson. Culture is not a soft issue, it is the bedrock of financial reality. A company with a rotten culture will, sooner or later, produce rotten financial results. An investor who ignores the qualitative signs of a lack of integrity is driving blindfolded toward a cliff. This brings us to the direct financial connection. How does a culture of integrity, a seemingly abstract quality, translate into a tangible, measurable financial advantage? The key concept here is something from finance theory called agency costs. Agency costs are the internal costs that arise from the inherent conflict of interest between a company's management, the agents, and its shareholders, the principals. In a company with a poor culture, these costs are enormous. Management might waste shareholder money on lavish corporate jets, opulent offices, or value-destroying, empire-building acquisitions that serve their egos rather than the owners of the business. They might manipulate accounting results to trigger their annual bonuses, even if it harms the long-term health of the company. They might resist a takeover offer that would be great for shareholders simply because it would cost them their jobs. These are all real financial costs that reduce the return to shareholders. In a company with a strong culture of integrity, one where management genuinely sees themselves as partners and stewards of shareholder capital, agency costs are minimized. These managers think like owners. They are frugal with company money because they see it as their own. They make capital allocation decisions based on a rational calculation of long-term return on investment, not on ego. They communicate with shareholders with transparency and candor. This cultural difference has a powerful and direct impact on the bottom line. It means that more of the company's operating profit actually flows through to become free cash flow, the lifeblood of shareholder value. Over time, this small but consistent advantage in capital efficiency compounds to a staggering degree, creating enormous long-term wealth for shareholders who had the wisdom to invest not just in a business model, but in a culture of integrity. This is the hidden financial power of character. We have now seen how reputation is built and how it can be destroyed. We have learned how to look for the cultural foundations of integrity. But to make this principle a truly rigorous part of our investment process, we must move from the qualitative to the quantitative. We must tackle the fourth pillar, the price of a bad name. We need to understand precisely how reputational damage manifests on the balance sheet and the income statement, transforming a soft concept into hard, undeniable numbers. The textbook case study for this is the 2010 Deepwater Horizon disaster involving the oil giant BP. For years, BP had cultivated a public image of being an environmentally conscious energy company, famously rebranding itself as Beyond Petroleum. But behind the greenwashing marketing campaign There were signs of a corporate culture that was cutting corners on safety to boost profits. There had been a series of smaller accidents and regulatory fines in the years leading up to 2010. The pre-mortem analysis would have raised serious red flags. Then, on April 20, 2010, the catastrophic failure occurred. The Deepwater Horizon oil rig exploded in the Gulf of Mexico, killing 11 workers and triggering the largest marine oil spill in history. For 87 straight days, oil gushed into the Gulf, a horrifying, real-time spectacle of corporate failure. The immediate impact on BP's stock was brutal, wiping out over $100 billion in market capitalization in a matter of weeks. But that was only the beginning of the financial pain. The price of BP's bad name was a long and excruciating series of quantifiable costs. The U.S. government hit them with over $20 billion in fines and penalties under the Clean Water Act. The company had to set up a separate $20 billion trust fund to compensate the victims of the spill, from fishermen whose livelihoods were destroyed to hotel owners on the Gulf Coast. The total direct cost of the cleanup, the fines, and the settlements would ultimately exceed $65 billion. This was a direct hit to the company's cash reserves and balance sheet, forcing them to sell off valuable assets at fire sale prices just to stay afloat. The price of a bad name wasn't a metaphor. It was a concrete, $65 billion liability that brought one of the world's largest companies to its knees. The market's reaction to a disaster like the BP oil spill is supercharged by a powerful cognitive bias known as the availability heuristic. This mental shortcut describes our tendency to judge the likelihood of an event by how easily an example of it comes to mind. A dramatic, vivid, and emotionally charged event, like an oil-covered pelican or a burning rig on the nightly news, becomes highly available in our collective memory. Because the imagery is so powerful and easily recalled, we tend to overestimate the probability of such an event happening again. For BP, this had devastating consequences. The vivid images of the spill became indelibly linked to their brand name. For years afterward, any mention of BP would immediately trigger these negative associations in the public's mind. This had several toxic effects. First, it led to widespread consumer boycotts and a permanent impairment of their brand value, particularly in the United States. Customers actively chose to buy their gasoline from competitors, not for reasons of price or quality, but because they didn't want to be associated with the company that caused the disaster. Second, it created a massive political and regulatory backlash. Politicians, responding to public outrage, were incentivized to impose the harshest possible penalties on the company. Third, for investors, the availability heuristic meant that the perceived risk of owning BP stocks skyrocketed. The possibility of another catastrophic accident, once a remote statistical probability, now felt like a very real and present danger. To compensate for this elevated risk, investors demanded a much higher potential return to be willing to hold the stock, which meant the stock price had to fall and stay at a much lower level. The availability of the disaster in our minds created a permanent risk premium that depressed the company's valuation for a decade. To counter these biases and make rational decisions, we need an applied mental model for pricing this risk. We can call it the reputational risk adjustment model. This is a way to systematically incorporate the potential costs of a bad name into your stock analysis and valuation. The first step is to calculate the trust premium or discount. In any given industry, you can compare the valuation of a company with a stellar reputation to that of a competitor with a history of scandals. Look at their price-to-earnings or price-to-book ratios. The difference between them is a rough measure of the market's trust premium. For example, a well-run regional bank might trade at 1.5 times its book value, while a scandal-plagued money center bank like Wells Fargo might trade at or below its book value. That discount is the market's way of pricing in the risk of future misconduct. When you analyze a company, ask yourself, does its reputation warrant the premium it's being given? Or does its risky behavior suggest it should be trading at a discount? The second step is to estimate potential liabilities. For companies in high-risk industries like energy, pharmaceuticals, banking, or aerospace, you must think like an insurance underwriter. Research the history of major industry fines and settlements. What is the typical financial penalty for an environmental disaster, a drug recall, or an accounting fraud? You should mentally bake a potential scandal tax into your valuation. What would a $5 billion fine do to this company's balance sheet and its ability to pay dividends? Treating this potential liability as a real, if probabilistic cost will introduce a vital margin of safety into your calculations. The third step is to model customer churn scenarios. In your financial model for a consumer-facing company, don't just assume a steady growth in revenue. Create alternative scenarios. What happens to the company's revenue and profit if a product recall or a data breach causes them to lose 5% of their customers overnight? What if they lose 10%? How sensitive is the company's intrinsic value to a sudden loss of customer trust? Companies with a fanatically loyal customer base are far more resilient to these shocks than companies with weak transactional customer relationships. The fourth and final step is to evaluate insurance and capital costs. Remember that a company with a poor reputation pays more for everything. They face higher premiums for crucial insurance policies like directors' and officers' liability insurance. When they go to the bond market to borrow money, they have to pay higher interest rates. These are not theoretical costs. They are real expenses that flow directly to the income statement and reduce the amount of cash available to shareholders. By systematically applying this risk adjustment model, you move the concept of reputation from the realm of opinion to the realm of financial analysis. You are pricing the risk of a bad name, which is a critical step in prudent, long-term portfolio management. The antithesis to this risk-aware approach is a seductive but flawed strategy, often called sin stock investing. The argument goes like this. Companies in industries with inherently bad reputations, such as tobacco, gambling, or certain defense contractors, are perpetually disliked by the market. As a result, their stocks often trade at very low valuations with high dividend yields. Proponents of this strategy argue that you can earn superior returns by buying these hated companies, as the bad news is already more than priced in. While this strategy can sometimes work for periods of time, it fundamentally ignores the concept of asymmetric left-tail risk. It is a strategy of picking up pennies in front of a steamroller. A tobacco company might trade at a cheap P/E ratio of 8 for years, generating steady dividends, but it lives under the constant threat of a single, catastrophic event, a massive, industry-killing lawsuit, a sweeping new federal regulation, or a sudden cultural shift that makes its product completely unacceptable. When that steamroller event happens, the stock doesn't just go down by 20%, it can go down by 80 or 90%, wiping out years of dividend payments in a matter of weeks. Warren Buffett, whose primary focus is on capital preservation, rule number 1, never lose money, avoids these situations entirely. He is not interested in collecting a few extra percentage points of yield if it means accepting the small but real possibility of a total loss of capital. The sin stock fallacy is the ultimate example of being penny-wise and pound-foolish. It sacrifices the certainty of long-term survival for the speculative possibility of short-term gain. True quality investing requires a partner with a name you can be proud of, not one whose business model is a ticking time bomb of reputational risk. Let's bring this all back to the numbers and make the final direct financial connection. A catastrophic reputational event, like the BP oil spill, unleashes a torrent of value destruction that can be clearly seen across the financial statements. First, on the balance sheet, you often see a massive impairment of intangible assets. The value of the company's brand name, which might be carried on the books as part of goodwill from a past acquisition, can be written down to zero, leading to a huge one-time accounting loss that decimates the company's book value. At the same time, liabilities explode. The company has to take on billions in new debt to pay for fines, settlements, and cleanup costs. This can dramatically worsen its debt-to-equity ratio, making the company far more financially fragile. Second, on the income statement, the pain is relentless. Revenue plummets as customers abandon the brand. At the same time, operating expenses soar. You have the direct costs of the cleanup and the fines. You have astronomical legal fees that can persist for a decade. You have a huge increase in marketing and PR spending to try and salvage the brand's image. You have higher compliance and safety costs as the company is forced to operate under a microscope. This toxic combination of falling revenue and rising costs crushes the company's profit margins and its earnings per share. Finally, on the cash flow statement, the damage is most acute. The company is burning through cash to pay for all these new expenses, all while its operating cash flow from the core business is shrinking. This often forces the company to cut or eliminate its dividend, a final blow to income-oriented investors. The price of a bad name is not an abstract concept. It is a quantifiable multi-year assault on every single line item that determines shareholder value. It is the reason why, for the prudent investor, a pristine reputation is not a luxury. It is a non-negotiable prerequisite for investment. We have come to the final pillar of our journey. We have seen how a great reputation creates a powerful offensive advantage, a moat of trust. We have confronted the terrifying asymmetric risk of its destruction. We have learned the techniques to identify a culture of integrity and to quantify the price of a bad name. Now we must tie it all together and elevate our thinking to the highest level of investing philosophy. We must embrace the fifth pillar, the long game. This is the understanding that reputation is not a static asset to be preserved, but a dynamic force to be compounded. It is the secret to transforming successful stock picking into the creation of true generational wealth. The ultimate embodiment of this principle is Warren Buffett's single greatest investment, Coca-Cola. In 1988, following the stock market crash of 1987, Buffett invested over $1 billion to acquire a significant stake in the Coca-Cola company. To many, it seemed like a strange move. Coke was already a massive, mature company. Where was the growth going to come from? But Buffett saw something that the market was temporarily overlooking. He wasn't just buying a company that sold carbonated sugar water. He was buying a century of accumulated goodwill, a reservoir of positive emotions and memories stored in the minds of billions of people across the entire planet. He was buying the share of mind that Coke had meticulously built since 1886. Think of the brand's association with happiness, with family gatherings, with Santa Claus, with a refreshing break on a hot day. This wasn't just marketing. It was a deep cultural imprint. This brand value was so powerful that it had even survived one of the biggest corporate blunders in history, the 1985 introduction of New Coke. The public backlash was so immediate and so intense that the company was forced to bring back the original formula, rebranded as Coca-Cola Classic. Paradoxically, this fiasco only served to strengthen the brand, as it reminded people just how much they loved and valued the original product. Buffett saw this powerful, globally recognized reputation not as a historical artifact, but as a perpetual money machine. He knew that this bond with consumers would allow Coca-Cola to slowly but surely expand its global footprint, introduce new products under its trusted brand umbrella, and consistently raise prices, year after year, decade after decade. He wasn't making a one-year bet. He was making a 30-year bet on the compounding power of a pristine global reputation. That $1 billion investment would go on to be worth well over $20 billion, paying him hundreds of millions of dollars in dividends every single year. It is the ultimate case study in playing the long game. The psychological principle that underpins the wisdom of investing in long-standing, reputable brands is known as the Lindy effect. The Lindy effect is a theory of longevity which posits that for certain non-perishable things, like a technology, an idea, or a brand, every day they continue to exist increases their remaining life expectancy. A book that has been in print for 100 years is more likely to be in print in another 100 years than a book that was just published last week. A brand like Coca-Cola or American Express, which has survived for over a century, has demonstrated a resilience that a 5-year-old startup has not. It has weathered world wars, depressions, changing consumer tastes, and countless new competitors. Its survival is proof of its durability. The Lindy effect works because long-standing brands have become ingrained in the cultural firmament. They are part of the system. They have built up enormous trust, distribution networks, and economies of scale, that are almost impossible for a newcomer to replicate. For a long-term investor, the Lindy effect provides a powerful mental model for filtering out the noise. Instead of chasing the exciting, fashionable new company that might be the next big thing but is more likely to be extinct in a decade, the Lindy effect suggests you should focus your capital on the boring but durable franchises that have already stood the test of time. Their reputation is not just a sign of past success, it is a statistical predictor of future survival and prosperity. This is the intellectual foundation for a portfolio built for permanence. How do we translate this profound idea into an actionable, applied mental model for our own forays into wealth management? We can use what I call the generational wealth framework. It's a series of questions designed to force a truly long-term perspective. The first question is the 20-year test. Look at the company you are considering and ask, with brutal honesty, can I confidently predict what this industry and this company's competitive position will look like in 20 years? For most companies, especially in rapidly changing fields like technology, the honest answer is no. The world is too uncertain. But for a handful of businesses, those with truly dominant and time-tested brands, you can have a much higher degree of confidence. You can be reasonably sure that people will still be drinking Coca-Cola, using American Express cards, and eating Hershey's chocolate in 20 years. A powerful and trusted brand is one of the very few sources of genuine, long-term predictability in a chaotic world. The second question is the global mindshare audit. How recognizable and respected is the brand outside of its home country? A company that has successfully exported its reputation across different cultures and markets has a much longer runway for future growth than one that is purely a domestic phenomenon. The global mindshare of a brand like Nike or McDonald's is an economic asset of almost incalculable value. The third question is the heirloom question. This is a powerful gut check. Would you be comfortable buying this stock, putting the physical stock certificate in a safe deposit box, and leaving it to your grandchildren in your will without being able to check the price for the next 50 years? This question forces you to completely ignore short-term market fluctuations and focus only on the extreme long-term durability of the business and its reputation. If the thought of doing this makes you nervous, it's probably not a true generational wealth compounder. The fourth and final question is the capital allocation test. How does the company's management use the enormous profits generated by its powerful brand? Do they reinvest it wisely to strengthen that brand and expand the business, like Coca-Cola did for decades? Or do they squander it on foolish, overpriced acquisitions outside of their circle of competence, or on excessive share buybacks at inflated prices? A great reputation can be squandered by poor capital allocation. Reading a decade's worth of a company's annual reports with a special focus on how they deploy their cash is the final check on whether management is a worthy steward for your long-term capital. The antithesis of this patient, long-game approach is the frantic and ultimately self-defeating behavior of the 99%, trend-chasing and hot stock investing. This is the constant search for a shortcut to wealth, a lottery ticket that will pay off big. The late 1990s dot-com bubble was the ultimate expression of this mentality. Investors, gripped by a speculative fever, poured billions of dollars into companies that had no profits, no revenues, and in many cases, no finished products. What they had was a fashionable business plan and a name that ended in .com. Companies like Pets.com or Webvan.com achieved billion-dollar valuations based on nothing more than a story. They had no long-term track record, no established brand, no culture of integrity, and certainly no durable competitive advantage. They were pure narrative, completely untethered from economic reality. When the bubble inevitably burst in 2000, these companies vanished, taking the life savings of countless trend-chasing investors with them. This is the perennial danger of confusing a popular stock with a great business. Popularity is fleeting. Reputation is earned. The path of the 99% is to constantly chase what is hot, jumping from one narrative to the next, always paying top dollar for hope and speculation. The path of the long-term investor is to ignore the hot trends and quietly buy pieces of wonderful, reputable businesses at sensible prices, knowing that the enduring power of their brand will carry them through any market fad or economic cycle. It is the difference between gambling and investing, between hoping for a quick hit and methodically building lasting financial freedom. This brings us to the final and most powerful direct financial connection: the magic of compounding. A company with a sterling reputation, a durable brand, and a long runway for growth is the perfect vehicle for compounding capital over a lifetime. Let's revisit See's Candies. Because of its reputation, it could raise prices by 10% per year. This price increase flowed almost entirely to the bottom line, meaning its profits also grew at a healthy rate. Because the business was so simple, it required very little new capital to grow. This meant that almost all of the profits it generated were free cash flow that could be sent back to its parent company, Berkshire Hathaway, to be reinvested elsewhere. This is the dream business, one that grows without consuming capital. Now consider Coca-Cola. It uses its profits to expand into new countries, to advertise to reinforce its brand, and to pay a steadily growing dividend to its shareholders. If you had bought Coca-Cola stock in 1988 with Buffett and reinvested all of your dividends, your initial investment would have compounded at a rate that would have turned a modest sum into a fortune. This is the dual engine of long-term returns. First, you have the compounding of the company's own earnings as it grows and strengthens its brand. Second, you have the compounding of the dividends you receive and reinvest. This is how real generational wealth is built. It is not through timing the market or finding a 10-bagger overnight. It is through the slow, patient, and relentless accumulation of value, powered by the durable and predictable earning stream of a business that has earned the trust of the world. A pristine reputation is not just a defensive shield that protects you from loss. It is the ultimate offensive weapon, the engine of the compounding machine that is the sole objective of any serious program of long-term investing and portfolio management. You have just invested a significant amount of your time and attention, and in doing so, you have acquired a powerful and timeless mental framework. You now possess the lens to distinguish a fragile flash-in-the-pan company from a durable, money-printing franchise. You understand that reputation is not a soft, immeasurable quality but a hard economic asset, a moat of trust that is the single greatest source of long-term competitive advantage. You have moved beyond the amateur's game of looking at stock charts and quarterly earnings and have entered the professional's arena of analyzing the character and culture of a business. This knowledge alone separates you from the vast majority of market participants. But this powerful understanding is only one part of a larger, interconnected system of thought. A great company with a pristine reputation can still be a terrible investment if you pay too much for it. The question of what to buy, the identification of a world-class business, is a challenge you are now equipped to meet. But the equally critical question of when to buy, the discipline of valuation and paying a sensible price, is a separate but essential pillar in the architecture of wealth. Knowing what a business is worth and having the patience to wait for the market to offer it to you at a discount is the link that connects brilliant analysis to brilliant returns. The video that is about to play on your screen is the missing piece of the map. It is the bridge between identifying a world-class asset and acquiring it at a price that ensures a margin of safety and the potential for extraordinary growth. It shifts the focus from the quality of the business to the price of the stock, tackling the one crucial variable we have not yet fully explored. It is the discipline that turns a great company into a great investment. You have demonstrated that you are not a casual observer but a serious student of the art of capital allocation. You have taken a deep and meaningful step to separate yourself from the 99% who are destined to underperform. Do not stop your ascent here. The system is not yet complete. Complete your mental arsenal. Master the art of valuation, the final tool of the master investor. Click on the next video and take the final step from being a discerning analyst to becoming a true architect of your own financial future.